Hi, everyone. We are honored to be here and excited to present an enticing opportunity, Ultragenyx Pharmaceutical. My name is Jenna Sledjeski.
My name is Spector Townsend.
And my name is Minchak.
And together we are proud to represent the Villanova Wildcat Fund, despite that rough watch last night. Anyways, the student-managed fund at Nova begins our sophomore year upon the completion of the Villanova Investment Academy. After this, you're encouraged to apply as an analyst, and then a year later, a portfolio manager. As portfolio managers, we currently manage $3 million in our portfolio management class, and with that, also mentoring our underclassmen. So just to briefly touch on our performance, since our founding 5 years ago, we've actually been in the top 2% of asset managers as benchmarked against the Russell 1000. So now moving into Ultragenyx, it's key to understand their commercial business. This consists of 4 high-value rare disease franchises. The first of these is Crysvita, which treats a rare bone disorder by regulating phosphate levels in the body. The next is Mepcv, which acts as an enzyme replacement therapy for patients struggling with a severe metabolic disease. Then we have Dojolvi, which provides an alternative source of energy for patients with fatty acid oxidation disorders. And lastly, Evkeeza. This helps to lower dangerously high cholesterol in patients with a genetic condition. One thing to note here is that these are all supported by in-house manufacturing as well, which sets Ultragenyx away from other biotech companies. With that, we found a valuation disconnect where the market is really only valuing this commercial business and ignoring any upside to be found with their clinical pipeline.
As a result of the discounting of their clinical pipeline, there's embedded solvency risk that we view as invalid. For starters, their commercial business, as is profitable, excluding R&D. Obviously, R&D is a large part to the clinical pipeline growth story. This is where we see 2 differentiated financing solutions coming into play with royalties and priority review vouchers, or PRVs. In their Crysvita royalty structure, they're able to take advantage of payment holidays as well as capped payment structures to maximize near-term cash retention without giving out too much feature upside. We see this as a viable and repeatable structure for other growing commercial lines. PRVs are non-dilutive grants awarded by the FDA when approved for a drug that treats a rare childhood disease. They're functionally cash. We see DTX401 as the likely PRV candidate for Q3 of 26, whereas UX111 holds slightly more variability, which Mike will get into in just a moment. The point I want to make here, though, is that it's rare to see an unprofitable biotech company have such a strong commercial base to rely on, which is why we see solvency concerns as heavily mitigated and overblown in their valuation structure.
So then in assessing the commercial business and then comparing that to the current valuations we're seeing in the equity markets, we arrive at the conclusion that the clinical pipeline, which is the source of all excess return and an extra opportunity for the name, has been materially mispriced to the point where the 5 clinical pipelines, along with multiple catalysts in the coming years, essentially are being unpriced and materially discounted relative to current valuations. Looking at one and providing an example of this, we'd like to talk briefly about the UX111 pipeline, which attempts to treat Sanfilippo syndrome. Essentially, this company has sought approval for this pipeline in the past year at 2 different occasions, but both times the FDA took it back on concerns regarding chemical and manufacturing controls rather than actual efficacy and effectiveness of the drug to treat the pipeline. The stock showed in this news, but we don't necessarily view it as a detriment to the long-term thesis, rather a delay in cash flows, which again, we don't necessarily view as a all-in-all negative given the diverse financing options, as Brandon had mentioned. But to really paint the picture for a really difficult 2025 for the name, we'd like to briefly offer commentary about setrusumab, a pipeline that aimed to treat osteogenesis imperfecta. Essentially, it's trying to have these patients be able to live a little bit more normal lives without the risk of overwhelming fractures. The company had 2 different attempts or times that they could have stopped the study this past year with good data to send to the FDA, but in both instances, they missed on their primary endpoint, which was the annualized fracture rates. That said, we took a bottoms-up approach to actually understanding how this trial was ran and look at the data in terms of confounding variables to see exactly where we could find opportunity within this pipeline when the market's pricing it as a binary failure today. The stock sold off 40% on the top line news. What we did find, though, with a secondary endpoint in bone mineral density was a statistically significant deviation from the current treatment and the placebo. Ultimately, what this means is the drug did have an objective effectiveness in increasing bone density, despite the fact that it missed on the fracture rate endpoint. Pair this with the interesting paradox we see in the name, where patients who were actually provided testimony being in the patient population that were on the drug in the pipeline They reported higher activity levels throughout the duration of the trial, which ultimately meant they had greater life expectancy and a better time living on the drug than not. But this could potentially skew fracture rates upwards, leading to the miss on the annualized fracture rate primary endpoint. But that said, we view the bone mineral density, the more objective endpoint, as a criterion that is acceptable in a totality of evidence review. We also see that the FDA has used this as a surrogate biomarker for osteoporosis trials, which is genetically and biologically similar in terms of disease. So again, we think from a totality of evidence standpoint, this drug pipeline should be ascribed some value in the market today. We're only pricing in a 20% probability of success, but at the same time, while the market is treating that as a binary failure, we see that contributing to about $5 of upside in the name. So in total, while we're not trying to make the case the target price should instantaneously be $65 a share, the argument that we're trying to make is there's asymmetric risk-reward opportunity in the name, especially in just life sciences in general. You see a lot of biopharmaceutical companies have risk-reward tainted to the downside with execution and FDA risk. That said, with this name in particular, we believe the commercial valuation provides a floor where all of this clinical upside and meaningful catalysts in the near term could provide incremental upside while a muted downturn in any of those extraordinary cases.
So just to summarize our thesis in a little bit of a simpler manner, we basically view the commercial pipeline as providing a very strong floor or high floor for valuation, whereas the discounting of the clinical pipeline provides a basically free option that we think attributes a lot of upside. So happy to answer any questions you guys might have.
Well, great. And first, thank you for this presentation, and also congratulations on the performance. That's incredible. So congrats. I guess just to follow up on those 2 points, and I did take a peek at the chart of the stock while you were talking, and I noticed those 3 drawdowns in 2025. Do you feel that, and again, this is biotech, so we know about the volatility and how subject to big price swings these types of stocks can be. Do you feel that those 3 drawdowns in 2025 into February of this year give you more confidence in pillars 2 and 3, or does it create more pause that you're like, hey, maybe this is just too volatile for the portfolio?
I can answer this one. I think we found that, as you mentioned, volatility is kind of par for the course in a biotech name. With that being said, even relative to a year ago where there was value being placed on their clinical pipeline, the current valuation entry level essentially provides the clinical pipeline at a valuation of 0. So we're just making a bet that the commercial pipeline continues to produce, and any upside, particularly in the drugs that Michael mentioned, any success or any probability of success increases in that will favor our thesis heavily. So I guess the point on the price drawdowns being brought to $20 a share roughly every time bad news was released sort of reaffirms our belief that the floor is the commercial business valuation.